Hey, thanks everyone for being here today. For those of you that haven't met me yet, I am Megan. I am the newest GPA member. I was brought on to help the JPA team help you. So I'm here kind of to help your operational pain points, improve processes, all those kind of headaches. So please reach out to me. Also, we know that you're busy, so we wanted to thank you today for joining us on the webinar. We're going to talk about the power of the P&L as explained by Martin Traub-Werner, which is very exciting. The webinar is being recorded. So for those of you that don't know Martin, I'm sure that you're familiar with his work as the creator of VetSuccess and the founder of VetBooks. They are a veterinary-focused bookkeeping service that helps take the headache out of bookkeeping because we all know it's a headache. The team at GPA loves working with Martin, and we're confident after today's discussion, you'll find him just as brilliant as we do. So without any further ado, Martin, please enlighten us.
Yeah, great. That's low-hanging fruit. Find me brilliant. Okay, let me try. Let me try real hard to be brilliant. I appreciate the intro, Megan. Thank you so much. My name is Martin. I am the founder of VetBooks, which I started a pile of years ago through my work with VetSuccess. VetSuccess, of course, the first business intelligence and data analytics company in the industry. And we were putting all this data in front of practice owners, and they'd be like, okay, listen, I love the visits data and the ACT and the lapsing patients, but can you tell me about my profitability? I was like, your profitability? No, I can't tell you about your profitability. The only way to get that would be to do your books in a consistent way every single month using the AHA chart of accounts, using accrual accounting. They're like, you should do that. I was like, wait, what? That's crazy. And it is crazy. It's a really audacious thing. And we've been at it since 2017. Took a little bit of a hiatus for COVID. You might remember COVID. That was the time where we were trying to convince people that they should switch their bookkeepers. And they were saying like, what? Switch my bookkeeper? I'm just trying to survive out here. What are you talking about? Switch my bookkeeper. We service a little over 80 practices now. What I love about it is the power that you get from a clean set of financials and the decision making that can come from it. And so today I'm excited to spend some time sharing with you my favorite business report, the P&L, and I've got a deck here that I'm going to share. And let's see here. And slideshow. We can see that okay? Okay, I'm also going to move my screen, the video portion of this over on my computer over here. So if you see me looking over here, I'm looking at you. If you see me looking over here, I'm looking. And the last thing I'll mention is there is some audience participation, so stay tuned. We'll pull up the chat box and get rolling. Okay, so let's see here. I've got my contact information. I'd invite you to find me on LinkedIn, where I'm reasonably active. And also, if you have any questions, comments, concerns, follow-up, feedback, or just want to say hello, you can drop me an email, martin@vetbooks.com. So I mentioned quickly, VetBooks, we're an outsourced bookkeeping service. We're a solution to sole supplier bookkeepers, and we look to give practices their time back. We work exclusively in the veterinary industry and exclusively with independents. So independents, vet only, to the point that we had a prospect say like, listen, we'd love to work with you, but I need you to do my spouse's chiropractic business. And we said, nope, that's not on. We're truly vet only. Okay, so today, like I said, I'm excited about talking about the P&L and sharing with you how to read the P&L, understand the story it tells. This is a muscle that you can exercise. The more you work at it, the more benefit and value your business gets. And at the end of our time together, my hope is that you can speak with confidence about what the P&L is, understand the key elements of the P&L, and also some early visibility into analysis. It is expected that at the end of this, you'll end up probably leaving with more questions than you have answers. And hopefully will awaken you to this. I'm like super excited. I'm a business operator. I'm like, yes, this is where you find out everything going on in any business whatsoever. And people are kind of like, wow, that's really a weird level of enthusiasm to have for a financial report. Okay, so first things first, big pet peeve. It's the P and L, not the PNL. The P stands for profit, the L stands for loss. It's the profit and loss statement. It's a statement of income and expenses in the business. It's how money flows through the business. And as a result, it's also known as the income statement. So income statement, P&L are synonyms. And it's the operator's guidebook. I come to this after I still am a business owner and business operator. I've been a business owner and business operator for a lot of years. My favorite meeting of the month is to sit with my business, my business leaders, and review the P&L and compare it against our budget. And it's different than the balance sheet, and I'll reference the balance sheet a little later. Because the P&L, it says here, you can see on the bullet, P&L is like it's like a movie. It's the running story of the business. You can look at what happened and what you want to happen and how it comes together. And the balance sheet it's a snapshot, a picture, a point in time of where the business is at that point in time. The P&L is where all the action happens in the operations. And importantly, the P&L is an input for tax planning and tax purposes, but there can be variations between the two. We were just talking before the webinar started. VetBooks does a lot of work with Granite Peak Associates clients. We are very used to handing over a P&L to the GPA team, and then they have a whole set of their own skills and wizardry and talent that they take the raw material from the P&L and provide great tax and consulting advice. Okay, here's what a P&L looks like, right? This is a simplified mini P&L. You've got money coming in, revenue, cost of sales, which is and we'll get into each of these elements, which is the variable costs used to generate the revenue. That you subtract revenue, you subtract cost of sales from revenue, that's your gross profit. That's all the money that's left over to run the business. And then you have operating expenses from that, and that leaves some amount of profit. And there's a bunch of different kinds of profit. I'm going to, for now, just refer to it as profit generically, and then we'll get into it, the differences between EBIT and EBITDA and operating profit and net income, all of which are some form of residual, some form of leftovers after you take your revenue minus your variable expenses, minus your fixed expenses, you have some kind of profit. And those are really the four big buckets. And so while this is a rolled up, simplified P&L, we were also talking before the webinar, which is remarkable because we were only together for just a few minutes, but we had a very deep conversation about how wildly complex veterinary businesses are. And you can tell because, and this is an eye chart intentionally, but because behind this simplified P&L is a boatload of detail. that is specific to the veterinary use case, right? And so these are complex businesses, and the more granularity that you have in your P&L, the more granularity you have in the breakdown of your revenue, your variable costs, your fixed costs, and ultimately the profitability, the more levers you have to pull in order to make profitable decisions. So the P&L in the veterinary context is organized in a chart of accounts. And in 2016, 2017, something like that, AHA and VMG came together and put a whole lot of energy into the AHA, what is now called the AHA VMG chart of accounts. You can Google AHA chart of accounts. There's a 50-page document with field definitions, and it breaks down the categories that a veterinary practice should organize their financials into. So chart of accounts, it's a filing system, right? So you've got high level categories: your revenue, your cost of goods, your labor expenses, and others. And you keep track of those elements in using the chart of accounts. Again, the AHA VMG chart of accounts has about 250 some odd accounts just on the income statement, the P&L side of the business. On the VetBooks website, I'm going to use a whole bunch of terms on the VetBooks website. There is a accounting terms in plain English, which we pulled together after people said, like, hey, what was that? What's operating profit again? How does accounts payable work? So you can go there for a reference. Again, 4 elements of the P&L: revenue, cost of sales, expenses, and profit of some sort. I'm going to use earnings before interest and tax as profit. And so let's jump into each of these. So here we come to our first part of audience participation. Let's hear from you. Like, what do you think some of the top generators of revenue are? Just drop it into the chat. That would be helpful if I could see the chat. Yes, exams absolutely is exam revenue is big. Lab revenue, super big. Yep, surgery also. Vaccines. The answer is hilarious. Yes, $5 at a time. Prescriptions, for sure. Drugs and medication, absolutely big category. So yeah, so there we have a bunch of the bigs. Yep, exam revenue, right. So revenue is a bit of an easier one to think about because it's money coming into the practice. Here I'm showing you the top 20 revenue categories. This is just a sample practice, but in our experience, the practices are all fairly similar. And so, here you see exam revenue up at the top 20, ref lab, vaccine revenue, internet pharmacy, right? Online pharmacy, it's different than other drugs and medications in the practice, which are broken down into subcategories. Interestingly, what I love about this example is that dentistry revenue comes in at the 7th highest revenue category, and that is a statement of strategic intent, right? Like there are not that many practices where dentistry hits the top 10, and you have to be really intentional about it. And what I love about dentistry is, what we'll often say to our friends in practice, is if you can do 1 or 2 more dentals a month, that money goes straight to the bottom line. There are not a lot of variable costs. You've already paid the staff. Your equipment's already there. Like if you can figure out how to do that, that money goes straight to the bottom line. So I love to see dentistry high on the list here. Here's another visual. Oh, here we go. Here's another visual of practice revenue by category. Again, these three, pharmacy revenue, so all drugs and medication. This is a roll-up of drugs and medication. Professional services and lab revenue will usually add up to about 80% in terms of your revenue. Okay, so that's the revenue side of the equation. COGS, traditionally in like a manufacturing scenario, COGS is the cost of goods sold. It's the cost of making the product or service that the company sells. And for us in vet, it includes the money spent on getting those materials and securing those materials and any other costs that are directly related to those things. So the example that I always use is if you're selling lemonade, buying the lemons, the sugar, the cups, everything you need to make the lemonade would be COGS. And in our context, sometimes COGS is referred to as cost of sales or cost of professional services. So let's go back to audience participation and ask quickly, what do you think some of the top cost of goods sold are in the practice? A little less intuitive. Drugs and supplies, for sure. Preventives, yes, absolutely. Those are big ones. The other one that is, vaccine costs and drugs. The other one that is often overlooked, there you go, thank you, is lab costs, right? So you generate revenue charging for labs, there's cost associated with the labs, and so that is a cost of goods sold. Here's a view of top 20 cost of goods sold. No major surprises here. And another view of it, again, it is not a surprise that the top cost of goods sold mirror the top revenue categories. And so that is a second element. Again, a bit of an eye chart, but COGS can get pretty darn granular. Here you see things like anesthesia costs, boarding costs, in-house lab costs, ref lab costs. The AHA chart of accounts has makes a difference between flea tick, non-heartworm, flea tick, heartworm or combo. So it gets very granular. You see down below mortuary costs, fluid therapy costs. So, our job as bookkeepers is to look at all of your invoices and all of the purchasing history and break down the costs with this level of granularity so that you can understand the relationship between revenue and COGS, but that's a bit of foreshadowing. I'm getting ahead of myself. The third major category, so we've done revenue and cost of goods sold. The third major category is operating expenses, and OpEx comes in two flavors. There's labor and all other, because truly labor, as you know, is arguably the largest cost in a veterinary practice. These are characterized as fixed expenses. Even if nobody shows up at the practice one day to generate a penny of revenue, you are still going to have to pay the staff, pay the internet, pay for paper towels and pay for cleaning services and like all the stuff that just is a fixed expense to the practice, and as a result is commonly referred to as overhead. So here's a list of top 20. Again, it's one practice, it's just a sample, but there's very little variability. I could look at any one of your practices and you'll have a very similar breakdown in terms of OpEx, including the two. Most of these end up being comp related, whether it's direct compensation or payroll taxes or benefits as part of compensation, or 401k and that kind of stuff. The two notable that jump off the page are rent on practice real estate and credit card merchant fees. Credit card merchant rent you can't really do a lot about, and in many cases, if the practice owner, or as a practice owner, you own the building, there's an argument to be made that you should be paying as much rent as you possibly can. Although that is not tax advice, and Jared and the GPA team should be giving you that advice on setting appropriate market rents and all that. They're stepping it good. Credit card merchant service fees aren't really flexible. They are somewhat negotiable, and they should be shopped every 18 to 36 months just to make sure you're getting the best deal. On labor, the chart of accounts makes a distinction between owner veterinary comp, right? Associate veterinary comp and relief comp. So that's all your DVM labor. There's 3 categories. And then as for owner comp, there's also a separate category for owner management time. So if you want to really understand the cost of providing service, you have to separate out like what time is the DVM using to manage the business and manage the enterprise versus what of their time is used being doing doctor things. And so you try and get an understanding of that. And then the other thing that I really love about this is this granularity, and there are 18 labor chart of accounts. So the chart of accounts has 18 labor categories and subcategories. And the thing that I love about it is that it allows you to start having a strategy around what I refer to as labor leverage. So how many dollars of DVM, like how much DVM time or how many DVM dollars does it take to generate $1 of revenue in the practice? How many tech dollars does it take to generate $1 of revenue in the practice? And especially on techs, there's a lot in the literature these days and in the sort of in the community, a lot of talk about leveraging tech time up to the maximum of their legal capability, legal allowed skill set. And what is, I like to think about how much revenue can you generate? Like, can you minimize your DVM spend, maximize your tech spend, because a tech dollar it costs less than a DVM dollar, and the relationship between ratios and that the ratio of tech versus DVM labor. This is all fairly new thinking, and it only comes to pass when you really break down your labor and understand how it works and the interplay. So outside of labor, there's all the other operating expenses, right? So everything from your bank fees to cleaning to really just about anything that is not COGS or labor goes into this bucket. And there are many, many, many categories. And again, the job of a good bookkeeper is to categorize it and give you a snapshot of what's happened in the month in terms of your spending. Okay, let's play a game. Audience participation. Where would these items go? Your choices are revenue, COGS, or OPEX. So exam fees collected from clients. Revenue, absolutely. Thank you. Good one. Payments for landscaping. OPEX, yep, great. Futures purchased from a distributor. COGS, yep. Yep, surgery costs would be COGS, yes. Money paid to Zoetis for labs. COGS, thank you. Bonuses for the staff. OPEX, yep, labor, OPEX. Wellness plan fees. Revenue, yeah. So wellness plan fees are revenue, absolutely. There's a little bit of confusion about what happens if you start taking revenue in advance and having provided the service, and some of it has to sit on the balance sheet. And that's not a topic for today, but there's real complexity there. Jared, did I get that right?
You did. You hit it right. Yes.
Yeah. Yeah. It's like you can't recognize the revenue if you haven't provided the service, but you've collected fees for the service that you haven't actually provided. So it gets a little messy. Money paid to a relief veterinarian. It's OPEX. Yes. Thank you. Simparica rebates. Yes. COGS with a question mark. It is in fact COGS, because it goes as a credit to the heartworm expense, to the heartworm expense, right? So, bit of a trick question there. It is actually sort of like a negative expense, a negative COGS. Fees collected for boarding is revenue. Yes, thank you. And the monthly internet bill. OPEX, absolutely. So, all right, good job. Hopefully you feel comfortable. And most of these cases are pretty straight ahead. There is a great deal of nuance when you get into some of the detail, as an example, dealing with rebates, dealing with wellness plan fees, and those kinds of things. Okay, so you've got money coming in, you've got money going out, and the leftover is your profit, right? And so here we have EBITDA, EBIT, net income, operating margin, profit, net margin. All of these are a measure of the money that's left over after you take your COGS and your OPEX away from your revenue. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And it's a measure of your operating cash flow. It's a super popular metric, but for my liking, I like to strip out some of the complexity there. Amortization in particular is a non-cash element, and is a sort of reflection of the value. Gosh, didn't intend to get into this. The value of capital equipment that you've spent, sometimes years ago, being reflected in the cost of your operation. So it doesn't have a cost implication to it because you already spent the money years ago, but there's this concept that you have to pay for it over time. So you amortize it or you depreciate it over time, and that is reflected out of your revenue, but it's non-cash. So I kind of like operating margin or operating profit, which is just straight out revenue minus COGS minus OPEX, right? Revenue minus COGS minus OPEX, that's the cash that my operation generated. Yes, there's some other accountancy stuff that we have to take out of that, like depreciation and amortization. But if I'm looking at the efficiency of my operation, I just like to go super simple: revenue minus COGS minus OPEX. But importantly, the measure of profit is a function of the question that you're trying to answer. And so Jared and the GPA team are going to be focused on EBITDA. But from an operations perspective, like, you don't have a lot of control. Once you purchase a piece of capital equipment, you don't have a lot of control over the depreciation and amortization. You do have some control over revenue, COGS, and OPEX, right? And so I like to focus on the things that you can control. So here's a chart. This is something we produce monthly for our clients, and this turns into a bit of a game, right? So revenue's in green, COGS is in purple, OPEX is in blue, and operating profit is in orange. And you get sort of break it down into a rolling 12 months. And the idea, this is sort of like the gamification of the P&L. The idea is to maximize revenue as much as you can, minimize OPEX, minimize COGS, and that makes the orange line your profit line, your operating profit line, positive, right? You can see in December that the OPEX bar is higher than revenue, which led to negative profit. Anybody want to take a guess what happened in December that would make the OPEX line? 100% bonuses. That's exactly right, right? And so bonuses end up making this particularly lumpy. Now, or one heck of an office party. That's right. There's fire trucks. One heck of an office party is the funniest line. And so one of the things you can do with bonuses is you can actually plan for the bonuses and amortize them every month, and create a reserve for them. So you take it out a little. So you take a little bit out of your profit every month for bonuses, and then you can avoid this sort of lumpy view of profitability. So importantly, profit is not cash flow, especially EBITDA is not cash flow, right? Because there are these non-cash elements. So this is another little chart that I really like to look at this. It's a waterfall chart that shows and you can stop after the first 3 bars because that's where the majority of the action happens. Shows your revenue in minus your cost of sales minus your expenses. The rest is sort of operating cash flow. Yes, there are some other, accountancy kind of things there that affect cash. But this is a really nice visual view. And if you are starting to explore open book management or sharing your financials with your team, these kinds of visuals are super helpful to show, like, okay, this is the money that came in, but here's, we spent X on cost of sales and Y on expenses, and that leaves us with, $80,000 in the bank at the end of the day, right? And it's important that the team understand how this works, because this is where, like, as I was saying to somebody recently, like, this is a zero-sum game, right? You can't spend, if you're going to spend $1 more on, for example, what's really popular that staff want on a regular basis, more money, right? Or discounts, right? If you're going to give a client a 10% discount, you're going to give a client a 10% discount and your operating profit is only 5%, you are actually giving money away from you. Like you're taking the money's coming out, the money comes from it is a negative drain on your bank account, right? If you only make 10 cents on, if you only make 5 cents on the dollar and you give a 10% discount, or you make 15 cents on the dollar and you give a 15% discount, you are making no money, right? So it's really important to understand that this is a zero-sum game, that the only way to make more profit is to increase revenue with the same expenses, or to keep revenue constant and lower your expenses. It's a zero-sum game. Okay, so these are the 4 elements of the P&L: revenue, cost of goods sold, operating expenses, and profit. And once you've understand the relationship between them, you can start looking to analyze. And this is really the best reason to streamline and self-servingly, I will say, frankly, to outsource your bookkeeping, but to streamline your bookkeeping and get as granular as you can, as quickly as you can, is so that you can spend your time understanding these key relationships. And this is not a webinar on P&L analysis, although what I'd like to do is show you some of the ways that you can start to use elements of the P&L to analyze. And the first one is just straight up trend lines. Like, you can trend line anything. Here I've stayed super high level and shown a trend line of revenue versus a trend line of COGS. The solid line is this year. The dotted line is last year. On the revenue side, you always want this year's dot to be higher than last year. On the expense side, you'd really like to try and hold the line, this year's line, at or below last year. Again, sort of these are little mental games that you can start playing. And on the profitability line, you want to see preferably, well, so profitability line, you always want to try and see it above 0, and preferably higher than last year. The other the other thing I'll say on trends is, and this is true for all of the metrics that I'm going to be sharing, is that you can do it at the high level revenue, but you can get super granular. You can say, what's my revenue from flea tick and heartworm? What's my revenue from labs? What's my revenue from, exams? And right on down, and all of that. When you have sort of historical apples to apples comparison, you can build these trend lines, and it allows you to be a diagnostician. Veterinary medicine is a diagnostician's game. This is just the financial diagnostics of your practice. As a percentage of revenue, so you can do percentage of revenue also at a gross level, and then also at a micro level, a macro level versus a micro level. I love to talk about the rule of 20, which is somewhat controversial. It's not really controversial. It's a very simplified way of thinking about the practice finance. So if you take your revenue and you break it down into 5 buckets of 20, really, but four expense buckets of 20, leaving a 5th bucket of 20 for profitability. 20% to COGS, 20% to DVM labor, 20% to all other labor, and 20% to OPEX, right? Leaves you 20% of profitability. Now, that's dreamy and perfect, right? 20% EBITDA business would be great. 20% profitability business would be great. The minute any one of those numbers start shifting, right, it's a zero-sum game. So if you spend 25% on DVM labor, that's only going to come out of profit unless you grow revenue, right? If you spend 18% on COGS, that's 2% more that you can spend on labor, or that goes to profit. So you start to see this relationship between the elements as a percentage of revenue. And I'll say this at the end, which we're getting pretty close to, but I want to say it again now. There really is absolutely zero substitute for knowing your numbers really cold, like for being super comfortable with the financials of your practice at the most granular level that you can. At some point, the granularity, you can sort of get rid of some of the noise of the granularity, but knowing that it's there so that you can understand the roll up of how you get to this macro view, understand the elements of getting there is super important. So, here's a micro view of percentage of revenue. Total lab revenue in this example is 20% of revenue, and 17% comes from outside lab, 3% comes from in-house lab. Like if your strategy was to bring everything, as much of it in-house as possible, you're not doing so hot here. But if this is the right mix for you, again, I can't tell you whether this is the right mix for you, but I can tell you with accuracy what you're doing so that you can decide and make those strategic decisions about where you want to make your money and the kinds of services you want to provide. The other thing that you can do, so we've talked about trends, we've talked about percentages and percentage of revenue. The other thing you can do is you can start looking at some key ratios, like the revenue to the expense, for example, of therapeutic diet revenue. This is the beautiful thing about the AHA chart of accounts. The 4,000 series revenue accounts are matched by the 5,000 series cost of goods sold accounts. And so you have therapeutic diet revenue that matches therapeutic diet costs. When you know the revenue of a thing and you know the cost of that same thing with accuracy, you have what's called the gross margin, right? The margin, that's the revenue minus the COGS is the gross margin. You have the gross margin of that thing. And in this case, you're making 48 cents on every dollar you spend on therapeutic diet product costs. Now, it's not 48 cents of profit, because from that, you still have to think about the time to service the client, the inventory carrying costs, the potentially the lost opportunity of having a storeroom full of food rather than having it as an exam room. So there's costs associated with that 48 cents that you've made, but it is 48 cents on the dollar. Looking again here at lab, reference lab in this case is $1.56 for every dollar that you make, and that sure feels like a good deal in terms of the relationship of revenue from ref lab versus the expense associated with the generation of that revenue. So in addition to trend lining, percentages and percentage of revenue, and key ratios, there's a whole lot of analysis to do on the balance sheet. I at the risk of offending our GPA friends, I'm a bit of a balance sheet hater. It's like to me, it's the least interesting, it's the least exciting part of the business. It's important. And I still have a very dear mentor of mine, who's very instrumental in my early career and a very successful a business person. And he said to me, he said, Martin, remember, running your business is a P&L activity. Your life is a balance sheet activity, right? So, the balance sheet. So when I think about like what's going on in my life, the balance sheet is like, okay, how much of my house do I own? How much cash do I have in the bank? What are my upcoming liabilities in terms of my kids' education? And that's sort of a one-time sort of picture of my net worth, net wealth, net health, right? But for me, the action is all in the P&L. Balance sheet is important, but it's a check-in on a regular basis. From an operating perspective, it's on the P&L. Benchmarking. This seems like this is going to feel all of a sudden it's like I'm beating up on the other types of analysis you can do. Benchmarking is a little fraught, honestly, especially in our industry, because it's really hard to get apples to apples comparisons, and that's especially true on the financials, on the expense side. On the revenue side, lots of PIMS work being done. On the visit side, lots of PIMS work being done. So sort of on the revenue generation side of things, we can get pretty decent benchmarks. But honestly, and at VetBooks, we're working to solve some of the benchmark problem. But honestly, this goes back to my comment earlier. The best thing you can do is understand your numbers cold and benchmark against yourself. Know what you did last year, know how that felt and how comfortable or uncomfortable it was, and put in place the strategies to make the change that you want to make. And the P&L is the canary in the coal mine. It's the harbinger of what is happening in your practice. And you can, by monitoring the P&L, by understanding the financials, is how you is the best way to benchmark. And then last is, and related to that, is budgeting and scenario planning. So once you've gone through a full year's cycle where you've got a clean P&L, and you might be there already today, if you've got a clean P&L, you can load into your financial management software like QuickBooks a budget, and you can start targeting like, okay, last year we did $150,000 of revenue in February. This year we want to do $175,000 in revenue. Well, how are you going to do that? And then you get into the granularity. Well, we're going to increase our lab costs by 2%. We're going to our lab fees by 2%. We're going to increase our exam fees by 1%. And you kind of tweak and manipulate the numbers, because once you know your numbers cold and you have the feel for them, the gut understanding of, and you can connect how the practice feels on a daily basis with what the financial outcome of that looks like, you get into this sort of symbiotic. This is getting a little esoteric. It's like the symbiotic relationship between your day-to-day activity and the financial outcomes when you're really, really connected to your financials, and the P&L is the way to do that. So financial analysis is where the storytelling happens. It allows you as an analyst or GPA as advisors or any other consultants you have to figure out what's happening in the practice. And with a dose of natural curiosity and, importantly, clean, reliable data, you can absolutely unlock the power of the P&L. And that is the end of my formal comments. And I can stop there.
That was fantastic. Thank you. I took lots of notes. I hope everyone else did as well. Okay. Thank you so much, everyone, for being here, especially Martin. That was fantastic. I know for me personally, looking at all those numbers can be overwhelming. So we're thankful for you breaking it down in a way that we can understand and share with our staff as well. We appreciate everyone who made it today to the end of the call. Mark your calendar for next month's webinar, which will be Friday, May 10th at noon Eastern. So same day, same time, same place. And shameless plug, if you've been enjoying our monthly webinars and are satisfied with the attention and service from the Granite Peak team, we would super appreciate a few kind words on Google. We are a small business just like you guys that thrives on the word of mouth and positive reviews. So I'm going to throw up a QR code for us if anyone's so inclined to go and leave us some words. That would be fantastic. And then we will see you guys next month. We'll be sending out the CE. So thanks for that. And we will talk to you guys soon. Thank you.
Thanks, Megan.
Bye.
Thank you, everybody.